All right, I think we are live now. So, hello and thank you for attending this week's lunchtime webinar from Hendricks Wealth Estate Management. I'm Jim Madl, financial advisor with our firm. I'm joined today by Tom Anderson and Dan Leitner. And today, as we're 2 days away from Halloween, I wanted to look at some of the most common financial fears for investors. During the course of this presentation, we're going to explore why these common fears exist. Then we're going to discuss the reality of why, as investors, we shouldn't let these fears interfere with our short and long-term investment goals. There is a Q&A button at the bottom of your screen for you to add any questions, and I'll look to answer any of those following the presentation. So let's get into it. And let's start off our discussion with a very common fear, inflation. Investors fear inflation because it erodes the real value of some investments by reducing purchasing power, especially for fixed income assets like bonds and saving accounts. High inflation can increase uncertainty, negatively impacting stock market performance in the short term and forcing central banks to raise interest rates, as we've seen lately. It further squeezes company profits and investment returns. Investors also worry about maintaining their future standard of living and the potential for economic instability, as high inflation can signal a deteriorating economy. Here's a breakdown of the reasons investors fear inflation. One, erosion of purchasing power. Inflation diminishes the value of each dollar invested, meaning that the purchasing power of money declines over time. For example, $100 today is going to buy less thanks to inflation than it did the year prior. Reduced real returns. Any monies in bonds, CDs, savings accounts, the fixed interest payment on those lose value in real terms as prices rise. If the interest rate does not keep pace with inflation, the investor's real return is negative, causing a feel like a loss of wealth. Increased interest rates. Central banks often respond to high inflation by raising interest rates to cool down the economy a little bit. This increases the cost of borrowing for companies and can lead to lowering consumer spending, further hindering stock performance. And the negative impact on the stock market. High inflation can create short-term volatility and uncertainty in the stock market. With inflation, companies face the challenge of absorbing higher costs, and the fear of rising interest rates that coincide with inflation can negatively affect stock prices. Now let's look at the reality. Rather than fearing inflation, investors can use strategic positioning and diversification to protect and even grow their wealth during periods of rising prices. A moderate level of inflation is normal and a healthy part of an expanding economy. Stocks can perform well in inflationary climates. While high inflation can reduce short-term volatility, a moderate level of inflation is often associated with strong economic growth. Companies with pricing power can pass rising costs on to consumers without a significant drop in demand, helping to maintain or even boost their revenues and profits. Inflation benefits debtors. The real value of outstanding debt decreases over time during periods of inflation, making it easier for borrowers to repay their loans with money that's worth less than when they originally borrowed it. Inflation also encourages investment over holding cash. Since we talked about inflation erodes the purchasing power of idle cash, it's an incentive to individuals and businesses to invest their money in assets that can provide a real inflation-adjusted return. This increased investment activity can spur economic development and innovation. For the next common fear, let's tackle the R word head on, and that's recession. Investors are afraid of recession primarily because it leads to potential losses in their portfolio due to declining corporate profits, increased volatility, and weakened consumer and business confidence. However, the fear can also be driven by psychological factors and uncertainty about when an economic downturn might begin or end. Reasons for fearing recession may include decreased corporate earnings and stock market declines. During a recession, reduced consumer spending and business investment cause companies to see slower revenue growth and shrinking profits. This leads to falling stock prices, threatening the value of investment portfolios. Increased market volatility and risk. Recessions create heightened uncertainty, leading to wild swings and rapid fluctuations in the market. There's fear-driven selling and panic. Market fear can become a self-fulfilling prophecy. Anxiety about a potential downturn can cause many investors to panic sell their assets, creating a negative feedback loop that drives prices down further. This behavior often results in poor long-term outcomes as panic selling locks in losses and prevents investors from benefiting from the eventual market recovery. And then there's uncertainty about timing and severity. Investors worry because it's impossible to predict when a recession will begin, how long it will last, or how severe it will be. The reality, it's important for investors to remember that recessions are a natural part of the economic cycle, and they present opportunities rather than just risks. Historically, markets do recover from downturns, and diversified long-term strategy can help investors weather the volatility. Here's the reality around recessions. Markets recover over time. While stock markets may experience drops during a recession, they have historically recovered. The S&P 500 has had strong cumulative returns in the 1 and 2 years following a recession, averaging nearly 20 and 30% respectively. Recessions create buying opportunities, as I said before. Economic downturns often bring down stock prices, allowing investors to acquire high-quality companies at a discount. As the legendary investor Warren Buffett, who you've probably heard of, famously advises, be fearful when others are greedy and be greedy when others are fearful. And recessions are an ideal time to capitalize on others' panic. Panic selling locks in losses. One of the most damaging things an investor can do during a market downturn is sell their investments in a panic. This just locks in losses and prevents the portfolio from recovering when the market eventually does rebound. Staying invested allows you to ride out the volatility and benefit from the recovery. And another reality, recessions are temporary and can be relatively short. Since 1950, the average U.S. recession has only lasted about 10 to 11 months, while expansionary or growth periods that follow are significantly longer. Maintaining a long-term perspective and recognizing that downturns are only a temporary phase of the business cycle is crucial for investment success. The next common fear is geopolitical instability. Investors are weary of geopolitical instability because it introduces uncertainty and unpredictability into the global economy. This affects investment decisions by increasing market volatility, disrupting supply chains, and influencing government policy, all of which can damage a company's profitability and an investor's returns. It increases market volatility and uncertainty. We know risks such as market conflict or military conflicts, political unrest, or trade disputes can trigger sudden and sharp price movements in stocks, bonds, and currencies. Investors fear this unpredictable volatility, which can create significant losses in their portfolios. In response, they may pull capital from affected markets and move towards assets perceived as safer, such as gold or certain government bonds. It disrupts global supply chains. International tensions often lead to sanctions, blockades, or restrictions on cross-border trade, which can disrupt the flow of goods, raw materials, and energy. For businesses, this can cause production delays, increased operating costs, and reduced profitability, all which ultimately can lower the value of a company's stock. It alters government and economic policy. Political instability can result in major shifts in policy, such as changes to trade laws, trade agreements, and government spending. For example, increased military spending can expand budget deficits and fuel inflation. It also creates financial stability risks. Elevated geopolitical tensions can damage the stability of financial institutions and even cause financial fragmentation, as banks may become more vulnerable to market and credit losses. This can in turn cause banks to curb lending to both businesses and consumers, which then reduces economic growth and further hurts financial markets. And it damages investor sentiment and confidence. Geopolitical risks increase overall market fear and risk aversion, especially in the short to medium term. As investor confidence erodes, they become less willing to invest in riskier, higher growth assets, which can cause the markets to decline. This negative sentiment can be contagious, potentially triggering herd behavior and causing widespread selling. The reality: market volatility from geopolitical events is often short-lived. While geopolitical shocks such as conflicts, political crisis can cause an immediate negative market reaction and increase volatility, historical data shows that markets typically recover relatively quickly from this. The long-term impact on returns is often limited, as fundamental economic factors tend to matter more over time than day-to-day headlines. A long-term perspective is key to success. Investors who react emotionally and sell during market downturns, locking in losses, and missing out on the market's eventually recovery. By focusing on their long-term goals and investment plans, investors can avoid panic selling and instead ride out this short-term turbulence. Global diversification can help mitigate these risks. Geopolitical risks are often regional in nature, affecting some companies more than they're going to affect others. By diversifying your portfolio across different countries, regions, and asset classes, we as investors can reduce our exposure to any single event. While markets sometimes move together, diversification can still offer significant benefits. As alluded to above, certain sectors and assets can offer resilience. Some sectors, like defense and cybersecurity, may even see increased demand during times of heightened geopolitical tension. And market movements are driven by more than just geopolitics. While these events are input into an input into the investment process, they're not the only factor at play. Investors must also consider other fundamental drivers like the state of the economy, corporate earnings, interest rates, and inflation, which collectively play a larger role in determining long-term market returns. Next is a very common fear that's the result of many of the other fears we're going to be discussing today, and that is straight out stock market volatility. Investors are afraid of stock market volatility due to the increased risk of losses, the disruption of long-term financial goals, and negative psychological impact of sudden market swings. So let's look into some of the reasons. Of course, it's a higher risk of losing money. Volatile markets with large, unpredictable price swings in either direction are generally considered riskier. Emotional decision-making. Anxiety and stress from market swings can provoke investors to panic sell their assets, often at the worst possible time. This emotional reaction leads to counterproductive behavior of selling low and buying high, which is exactly what we don't want to do, and it undermines their long-term financial success. Next would be economic and corporate uncertainty. So volatility often stems from economic uncertainty, such as concerns over inflation, geopolitical tensions, and potential recessions. These events create unpredictable environment for corporate profits, making investors nervous about the future performance of their holdings. And then fear of missing recovery. When investors do panic sell and pull their money out of the market, they face the difficult decision about when to get back in. This leads to the risk of missing out on the market's best performing days, which historically have clustered closer to the market's worst days. So again, their best days on the market usually closely follow their worst days. So what's the reality of stock market volatility? The reality is that based on what we've seen in the history of the market, long-term investors shouldn't fear volatility because it's normal, temporary and provides opportunity for you to build wealth. Reacting emotionally to short-term swings can oftentimes be more damaging than just staying the course. As I just stated, volatility is indeed normal, and while it sometimes doesn't feel this way, it's a temporary part of the market cycle. The stock market experiences periods of volatility as a regular feature, not an anomaly. The S&P 500, for example, has experienced an average intra-year drop of 14% since 1980. Yet, it's finished with a positive annual return in most of those years. This historical pattern shows that downturns are normal, they're a normal occurrence, and market generally trend upward over the long term. Short-term market noise is not a reliable predictor of long-term growth. Daily news cycles and short-term market headlines are often driven by emotion and noise, not long-term fundamentals like company earnings and economic growth. Investors who obsess over short-term movements risk making rash decisions such as selling during a dip, which just locks in losses and causes them to miss out on the market's eventual recovery. Remember, the market rewards patience, not panic. Volatility creates opportunity to buy assets at a discount. Market downturns can be seen as a sale on high-quality assets. When prices fall, patient investors can acquire strong companies at a more attractive valuation. For example, some stocks dropped significantly during the COVID-19 downturn in early 2020, but investors who bought at that time were well rewarded when the market rebounded later that year. Dollar cost averaging can mitigate the effects of volatility. Investing a fixed amount of money at regular intervals, regardless of market conditions, is a strategy known as dollar cost averaging. This practice helps smooth out volatility over time by automatically buying more shares when prices are low and fewer when the prices are high. This removes the emotion from investing and reduces the risk of trying and failing to time the market. Diversification provides a cushion against market swings. A well-diversified portfolio that's spread out across different asset classes, industries, and geographies can help manage risk and smooth out returns during market turbulence. When one sector of the market is down, another may be performing well, which helps to mitigate these losses. Next, we're going to look at high interest rates. So after a prolonged period of low interest rates, this relatively recent shift to higher rates has fundamentally changed the investment landscape. Investors fear that a higher for longer interest rate environment will continue to pressure stock valuations and increase the fear of cost debt for both companies and consumers, leading to fear of the following. Reduced corporate profitability. When interest rates rise, the cost of borrowing for company or for businesses increase, which raises their expenses and cuts into profit margins. This can deter companies from undertaking new projects or expanding as the required return on investment is now much higher. Slowed economic growth. To combat high inflation, central banks often raise rates to make borrowing more expensive, which slows down economic activity. Less consumer and business spending can translate to lower revenues and earnings for companies, further pressuring stock prices. And decreased bond prices. For investors holding existing bonds, a rise in market interest rates causes the price of their fixed rate bonds to fall. The higher rates on newly issued bonds make the older, lower rate bonds less attractive, so their market price must drop to compensate. However, what investors should keep in mind is that high interest rates should not be a cause for fear, but rather an opportunity for strategic positioning. Here's why. Quality companies can thrive. In a high interest rate environment, unprofitable or inefficient businesses that rely on cheap borrowing often struggle. This benefits the fundamentally sound companies with low debt, strong cash flow, and sustainable competitive advantages. And they're able to weather higher borrowing costs and potentially take market shares from their weaker rivals. It can be a good time to buy value stocks. Higher interest rates can compress valuations across the stock market, especially for growth stocks that are valued based on future earnings. This provides a window for long-term investors to purchase shares of solid companies at a discount, following the classic principle of buying low. The stock market has historically persevered. While a rate hike can cause short-term market volatility, history suggests that higher interest rates can coincide with a growing economy and higher stock prices over the long run. The stock market has constantly recovered from past downturns driven by high rates. And it creates opportunities in different sectors. Not all sectors are hurt by higher rates. The financial sector, for instance, like banks and brokerage firms, can see their profit margins increase by charging more for loans. Certain consumer discretionary stocks may also benefit in a healthy economy, signaled by higher rates. Meanwhile, defense sectors like consumer staples and utilities, which sell necessary goods, tend to hold up well during these economic downturns. Political landscape. Investors fear uncertain political landscape due to the potential for market volatility, policy changes, and reduced corporate profitability. The resulting economic uncertainty often leads to investor risk aversion and a preference for safer investments due to the following: increased market volatility, political uncertainty such as surrounding elections can cause stock and currency markets to fluctuate unpredictably. This instability makes it difficult for investors to forecast market performance and can lead to sharp market downturns as investors sell off riskier assets. Adverse policy changes. A shift in political leadership or priorities can lead to major changes in policies concerning taxes, trades, tariffs, regulations, or government spending. These changes can directly impact corporate profitability and can harm specific industries or sectors. For example, a shift towards stricter environmental rules could have negative impact on the fossil fuel companies. And reduce corporate investment. Faced with a high degree of uncertainty regarding future policies and market conditions, companies often become hesitant to make long-term, irreversible capital investments. And then lower investor confidence. Heightened political uncertainty erodes investor confidence, making them more risk adverse. This reduced confidence can decrease foreign investment and cause capital to flee towards safer assets, such as gold or government bonds, which can depress the value of domestic stocks and corporate bonds. Again, in reality, because all of these fears, there's a reality to all of them. And in reality, investors should not be afraid of an uncertain political landscape because market resilience, economic fundamentals, and diversification often outweigh short-term political noise. Maintaining a disciplined, long-term perspective is a key strategy for navigating these periods of uncertainty because markets are resilient and recover from political uncertainty. Historically, markets have shown an ability to endure and recover from periods of political turmoil, with any resulting volatility often being short-lived. For example, a surprise election result can often cause initial short-term market reaction, but once new information is factored in, the market typically resumes trading based on fundamentals rather than on emotion. Economic fundamentals matter more than politics in the long term. While political decisions can influence certain sectors, long-term market performance is primarily driven by powerful economic forces like corporate earnings, interest rates, and global trade. By focusing on high-quality assets and business fundamentals, investors can mitigate risks associated with political fluctuations. Remember, the stock market is comprised of companies that have leadership in place that are compensated to navigate policy changes and economic conditions to return a profit for their shareholders. Diversification protects against political risks. A well-diversified portfolio, which for some investors, based on their time horizon, includes a mix of different asset classes such as equities and bonds, and geographic regions, can act as a buffer against shocks. Spreading investments across various industries and countries can help balance performance during times of localized or sector-specific political disruption. And emotional reactions can harm your portfolio. Making impulsive decisions based on political headlines is a common pitfall that can derail an investment strategy and result in selling low. Successful investors separate their emotions from strategy and remain disciplined through the market cycles. So I hope this past half hour or so has helped ease any fears you may have about investing, or at least shed some light on how the market reacts to these common fears. We look to build out, here at Hendricks Wealth Estate, we look to build out a personalized plan for our clients to help prepare for their financial needs rather than taking a reactionary approach based on fear or emotion. Remember, if you have a solid plan in place that differentiates between long-term and short-term investment dollars, you can conquer all of these fears we just discussed. In my 5 years with the firm, I have learned that in addition to being financial advisors, we often serve as counselors, helping keep clients focused on their specific financial plan and keep them from overthinking or stressing about the day-to-day news headlines. So I'd like to dive into any questions you guys may have covering or discussing anything I've covered. So if you have any questions, please put them down in the Q&A section. I will look in there to see if we have any. I'm not going to keep you super long because we've used up most of the half hour we have allocated. While I'm waiting for any questions to pop up in the Q&A section, we host these webinars every Wednesday at 12:30 Central Time. And actually, we're going to be moving these to 11:30 Central Time starting on December 3rd. If you're interested in seeing our upcoming topics, I invite you to visit our website, and it's hendrickswealth.com, and click on the events tab. You can register for each of these events individually, and they happen almost every Wednesday. There's some where there's holidays in there, and like right before Thanksgiving, we're not doing one, but we have these scheduled every Wednesday. If you happen to miss a webinar, please visit our website again, hendrickswealth.com, and we do have them. All these are recorded and posted out there. So they're on our website under the Resource Center tab. Let me see. We have a question in here. What's the risk of going into money market funds if the market seems overvalued? So the risk of going into money market funds, there was actually a pretty good place for them until recently, when rates were considerably high, interest rates were considerably high. We had a lot of, you got a good return being in a money market. Some money markets were returning about 5.5%, which is phenomenal. The long-term problem with using a money market as an investment vehicle is it generally isn't going to get enough return to generate enough for our long-term goals. So we're usually looking to get an average of about 6 to 7% out of an asset, and generally money markets are not going to perform that. Money markets are a good tool to keep very short-term money safe and preserved, but for any long-term assets, not generally recommended. And I have another question here. How do we find good opportunities in the market that counterbalance volatility? What we do here is we build a plan. So we here at Hendricks Wealth Estate Management use mutual funds in our investment portfolio. The way we have everyone's plan set up is more personalized on their need for long-term and short-term monies. We build the plan based on those needs, and we generally try to protect about 5 years worth of distributions that are going to be needed. Now, how do we counterbalance volatility was the question here. What we do is we let the mutual fund managers, the people that are professionals at reading the economy and reading the day-to-day articles, we let them make the trades in our mutual funds that are going to have the best long-term profitability for us, or the best long-term gains for us. All right. I hope those answers helped you out. I don't see any more here, so I'm going to call it a day. Thanks so much for joining us for this half hour. And again, check out hendrickswealth.com/events for upcoming events every Wednesday. Take care, everyone.